Hello and welcome to Sense and Sensibility, the Inflation Guy podcast. You're talking to the Inflation Guy. I'm Michael Ash, and I am the Inflation Guy, and I'm your host. And today we're going to talk about a bunch of different things. You know, it's the summertime, it's the doldrums on Wall Street. You know, lots of people taking time off. In Europe and there are entire countries that go away for July and August. So it tends to be a little quieter out there. We tend to get fewer views of my blog and fewer downloads of the podcast. And at the same time, there's like a lot of stuff that's sort of happening and that I want to say a little bit about. And so I wrote and rewrote this episode a couple of times and decided ultimately that, you know what, I'm not going to write anything. I'm going to go with the kind of the snippets of stuff that I wanted to talk about, but that are each kind of a sub podcast. And so that's what we're going to do. We're going to talk about rent control. We're going to talk about market volatility and where to hide for the next couple of months, and things like that. But first, as always, I want to thank Simplify. This episode of Sense and Sensibility is sponsored by Simplify ETFs, a fast-growing manager of liquid alternative ETFs. Simplify is bringing Wall Street to Main Street by providing access to institutional strategies perfect for diversifying your equity and bond portfolios. Previously only available to big institutions and the ultra-rich. Check out their website, simplify.us. That's simplify.us. And you can find their entire lineup of ETFs at simplify.us/ETFs. So, and of course, this episode is always sponsored by Enduring Investments. You might suspect that's because I am the managing principal of Enduring Investments, and you would be correct. But I'm not going to give the actual pitch in the sponsor slot today because I want to move on. As I said, this is a little less structured, and so let's back up to July 11th. So July 11th. President Biden trying to tamp down all this crazy talk about how maybe he hadn't looked great during the debate. I'm soft selling this, obviously, but he gave a press conference, and I won't comment anything about the press conference other than to say that at one point in the press conference, he mumbled something about, if he's reelected, he's going to institute, nationwide, price controls on rents, limiting rent increases to 5% a year. And the people I follow on Twitter and the people who follow me on Twitter, I guess the inflation circular firing squad, if you will, sort of lit up at that. People started, tweeting, did he just say something? Did he just say that he was going to institute price control for rents? Because that's like a bad idea. And I think the hope was, he's probably, his mind's wandering. He didn't really mean that. Well, guess what? So, earlier this week, the White House announced that in fact, they are, that they're going to do a couple of things with the house to make rents come down in the housing market, and some of these are policies that will be proposed to Congress that they know won't pass. And so obviously a lot of this is political, but just the very idea of proposing price control, actually back episode 37, a year and a half ago or so, of this podcast, we talked about the episode title was Bad Idea of the Year, Wage and Price Controls. And I go in that episode, I go through kind of all the reasons that price controls are really bad. They've never worked. They never will work. And all of the kind of revisionist history about how they worked in World War II they're just wrong. I mean, they didn't work in World War II, and the history is very, very clear. But you can get much more on that topic by going back to episode 37, and there's a link in the show notes. But it's obviously sort of it's crazy talk. One of the things in a nutshell, if you institute nationwide price controls, and assuming that you could institute nationwide price controls as an administration, you certainly need legislation, I would think, but then again, the CDC shut down, instituted an eviction moratorium without legislative support. So anyway, lots of crazy things can happen. But if you institute a rent cap, then nationwide, then you'll get nationwide exactly the same effect as when you institute rent control inside of cities. And that is, no one builds any more properties. The existing properties become decrepit and run down because there's no incentive to a landlord the landlord can no longer affect the revenue side and charge what they need to charge. And so they can only affect the cost side. And so that means that the existing properties, they don't do maintenance on. And it also means that anybody thinking about building new buildings because of the great demand in this particular, in the city, won't build a new building because they build a new building and they can't charge rents that the big demand would sustain. So what happens when you institute rent control is you get worse rent problems. And it's really clear. All the research has shown that, there may be social justice reasons why you want to have rent control, make rent, everybody live rent free. The rent is too damn high. Fine. But you can't argue that there's a good economic reason. The economics are crystal clear that it's a really, really bad idea. So it's part and parcel of lots of other things the Biden administration have done, which clearly are bad economics, but maybe are good politics. Anyway, go back to episode 37 and you can, where I talk not just about rent control and price controls, but sort of generally speaking, what happens when you institute wage and price controls. Because a year and a half ago, the administration, the New York Times ran a piece. There was clearly some running up the flagpole of the question of, hey, what if we have this inflation problem? Why don't we just fix these prices and just say that they can't go up? And so I actually thought that, and again, the episode title is Bad Idea of the Year. And I thought that sort of and I said on another podcast for another podcaster, I said that my low risk or my low, what do you call it? The upcoming surprise of 2023, the possible surprise that was not priced in the markets was the possibility that the Biden administration would institute wage and price controls. And they didn't, and we're very happy that they didn't, but obviously the idea did not entirely die inside of the administration. So anyway, enough on that. While we're talking about rents, though, I also want to sort of address another question. And there's a link in the show notes. There will be a link in the show notes about to the blog that I posted yesterday, where I talk about this a little bit. But the question is, and I guess it's not really a question. It's just, I guess it's a debate that keeps happening, mostly amongst people who don't look at inflation for a living. But the question is about rents, and obviously, and we talk about this a lot on the podcast. Rents are a major part of core inflation. Owner's equivalent rent and primary rents. The lack of understanding about how owner's equivalent rent works is amazing. The number of people who really ought to know better, who say that owner's equivalent rent is set by asking homeowners, how much they think their house would rent for. That's wrong. That's not how it's done, and never has been done that way. But there's a bunch of people who will tell you that's how owner's equivalent rent is done. It's not. That question is used to help set the weights in the CPI, but the actual prices themselves are set by a survey that's very similar to the primary rent survey. All of this information is on the Bureau of Labor Statistics website, white papers about how they do rents, and actually the the manual of methods, the handbook of methods is on there. It shows you exactly how they do it. But anyway, all that aside, there's obviously a lot of misinformation about how rent works, how OER works. But and actually, I wrote about owner's equivalent rent and back on episode 7. I think it was called Rents and Sensibility was the name of the title. Yeah, Rents and Sensibility, episode 7. So that'll be in the show notes as well. But again, if you want to know more about rents and how that works, you can go back to episode 7. But I wanted to, and we just talked about the possibility of rent control and so on. But one of the things that you hear a lot today is that, the CPI for rents is coming down, but there are lots of other higher frequency data that say that we should be in deflation in rents. And so there are a lot of people who think that the owner's equivalent rent and primary rents are going to go to deflation. And I've talked a lot before about why that's not going to happen. And there's also the paper came out a year ago or a year and a half ago or so from, I think it was the New York Fed, some researchers at the Fed saying that you could take the CPI data, the rental data, and break it apart and get better information if you only looked at part of it that moved faster. And then, the ATRR and NTRR, what the indices are. And those move faster, and those also show that we'll be in deflation soon. Again, I argued this at the time. I don't remember the episode right now that I talked about it, but if I do remember, I'll put it in the show notes. But basically, in a nutshell, the reason that doesn't work is that you can't take, it's just information theory. You can't take a given collection of data, take some of it away and get better information unless there's something systematically wrong with the data that you're taking away. And there's nothing to suggest there's anything systematically wrong with the BLS survey. So when you take data away, you can get information that looks like it has, it's more timely. But in doing that, you create much bigger error bars. And in fact, if you look at the research paper that was done for the ATRR and the NTRR, what the people who wrote the paper clearly pointed out is that the error bars get really, really wide for short-term forecasts. So wide that you really can't reject you certainly can't reject the question about whether or not the owner's equivalent rent survey or primary rents are wrong. But anyway, you can argue the information theory point to your blue in the face. You can point out that, all of those indicators said that we'd already be in deflation in the CPI, and we're not. It doesn't matter. It's a fancy new survey, and so it gets reported a lot. But anyway, in the blog I posted yesterday called "The Residual Effect on Rent Inflation of the Eviction Moratorium." I put up a couple of charts, and the one I think is kind of interesting is something that I started following back in early 21. When the eviction moratorium went into place, what you saw was that although effective rents went down, because if you can't throw anybody out for not paying rents, then guess what? You don't get to collect as much rent. The asking rents went much higher, so there was much less turnover, but the asking rents went up a whole lot. And ordinarily, these three series, asking rents, which is a U.S. Census number, effective rents, which I get from REIS, and the CPI for rent of primary residence, which comes from BLS, those ordinarily, for a very long period of time, they move together. And they should, right? So over time, as the price level goes up, your asking rent should go up, your effective rent should go up, and if the BLS number is doing its thing correctly, it should go up as well. And that's what happened for decades. Until the eviction moratorium, when all of a sudden effective rents went down, asking rents went way up, and the CPI for rent to primary residence slowed down a little bit and then started to accelerate. And essentially, what this chart shows is that the surge in rent that happened after the eviction moratorium was lifted, you kind of knew that it was going to happen. In fact, again, I said before that all happened, I said that was likely to happen because you could look at the asking rents and say, well, either asking rents have to come down a lot, or the actual effective rents, people will actually have to start paying those things and they'll go up. And that's what happened when the eviction moratorium was lifted. And as an aside, what that tells you is that we had price control. Okay, we had an eviction control, but effectively we essentially had some kind of price control. If you can't throw people out of your apartment, then you certainly can't charge them a higher rent that they don't want to pay because they just won't pay it, right? And so for a period of time, there was this control on the rental space. And when that control went away, guess what? Prices caught up. And so part of what happened to the surge in rents after the lifting of the eviction moratorium was entirely forecastable, and we forecast it. It was entirely foreseeable, and it was exactly what happens when you have rent control is you don't stop prices from going up. You just move things to the black market, or you delay them until you eventually have, the system breaks and you have to remove rent control and then prices catch up. That's what happened in the 70s as well. But anyway, what's interesting about this chart is that let's go back to the question of, are we in sort of deflation near term? And what you can see from the chart is that over the last year or so, the line for effective rents has gone flat to slightly down. The line for asking rents has gone flat. And the line for CPI of rent to primary residence has continued to go up. And of course, that's the big debate, right? Why is the CPI continuing to go up? But what you can tell from the chart is that the reason the CPI is continuing to go up is it's still catching up, right? So all of these things which have gone flat aren't necessarily presaging the CPI going flat, CPI for rent to primary residence. We don't know. Once the CPI catches up, it may be that asking rents and effective rents start going up again, right? So if something goes flat because it was way far ahead, think about, okay, you're going out for a run and you're running with your kid, and your kid is much faster than you, so your kid runs on ahead. Okay, kid gets far enough ahead, eventually the kid stops and waits for dad. Okay, I know this firsthand. But anyway, so the kid stops and waits for dad. And then dad eventually catches up. Well, if you look at a plot of the kid's velocity, it went to zero, right? It was faster than you, and then it went to zero. Does that mean that once you get to him that you go to zero as well? Well, no, the kid starts up and starts running with you again, right? So the point is there's no way to really know the simple fact pattern. You don't know what's going to happen when those two lines come together. And by the way, I just came up with that analogy like right now as I was talking. But that's what's happening here. The CPI won't necessarily decelerate because these other things have decelerated. It may be these other things have decelerated because they'd gone too far too fast, and they're just coming back to the overall trend. And it may be that the CPI for rent to primary residence, because it moves slower, is a better measure of the actual underlying trend. I don't know the answer to that question, but I think that in the chart certainly makes the point that that's certainly a plausible interpretation of what's happening. And certainly my model for rents, which is sort of built up from costs, suggests that CPI rents should decelerate for a while here, another probably 3 to 6 months, and then start to accelerate again. And that's not inconsistent with what's happening in these other primary surveys and things like the census data on rent to the asking rents and the REIS data on effective rents. Anyway, something to keep in mind. Look at that. We'll have a link to that blog in the show notes, but it's the most recent post on my blog. So, okay. So there were a couple of things about rents that I wanted to say. And it took a lot longer to say than I thought. But I did want to say a little bit about the investing environment. I don't talk a whole lot on this podcast about exactly how you should invest because honestly, it depends so much on you that there are certain principles that are involved, but I can't tell you exactly what you should do. However, I think it's worth occasionally pointing out some circumstances about the landscape. And right now, not that I'm counting, but it's about 110 days to Election Day in the U.S. And by the way, for what I'm about to say, I for the investing takeaway, I just want to make clear that most investors should not make major shifts, like hardly ever, but certainly on the basis of what I'm about to say. You should leave market timing to the experts, because markets tend to march. The equity market tends to march upward over time because bond yields tend towards an equilibrium, and because of the way commodity prices behave, the way you actually allocate based on sort of what will happen over the long term is a pretty reasonable approximation of how you should be invested at every point from now until the long term. Okay, making occasional course adjustments, investing a little bit more in equities when they're cheap, a little bit less when they're expensive, investing more in inflation-linked bonds when when real yields are high and less when they're low. Adjustments like that can be modeled and make a lot of sense. What I'm about to talk about is a very short-term question, and that is, hey, we're we're less than 4 months away from the election. Does that mean anything to me as an investor? Now, normally we would anticipate there's some mild volatility as you approach the last month or so before the election. The one thing that is never a surprise is that there's always an October surprise. You don't know what it's going to be, but there's always something. And there's going to be some volatility around that event. And that would be normal, and I wouldn't even think about it, address my asset allocation for that. But in 2024, we have a couple of weird circumstances and conditions that make me and should make you nervous. One is, of course, that we just had an assassination attempt on the leading presidential candidate from one of the parties, or the presidential candidate from the party that's leading in the polls. And it's an interesting intellectual exercise to imagine what would have happened in markets had the assassin succeeded in taking out former President Trump. My guess is that we would have come in on Monday and markets would have been down 10%, if not more. That would have been a disastrous outcome. It didn't happen, but, since the attempted assassination, and despite pleas from the party of calling the other guys fascist to turn down the temperature on the rhetoric notably hasn't been turned down at all. And so another attempt on Trump's life is probably an event with a non-zero probability attached to it. I don't really worry about an attempt on President Biden's life. I think the Republicans want him to be the nominee, although it looks like he may not be. But certainly, look, there's a lot of volatility. There's a lot of anger in this country on both sides. Betting markets right now make Trump an overwhelming favorite to win the election, which should reduce the chances of an October surprise. I mean, if you're 1 month before the election, you're starting taking early voting, and one candidate has a 90% chance of winning and is going to take 400 electoral votes or whatever. If you're the party that's going to be the backbencher party, the minority party, you probably shouldn't spend any bullets trying to do anything, surprisey, because it's not going to make any difference, right? You would think that would happen when you get kind of close, but I just, we were just talking about the announcement about nationwide rent control. So you could potentially get some really crazy stuff happening. And by the way, not least of that is that the party that's behind in the polls might simply jettison its duly nominated candidate and put somebody else in there. What does that mean for markets? I haven't the faintest idea, except that it's volatility. So we're talking about threats to candidates. We're talking about substitution of candidates. We're talking, the potential that if you're a Democrat and you don't want Joe Biden to run, one of the ways to do that is to call the 25th Amendment and remove him from office. Do I expect that? No. Is it possible? Abso-effing-lutely. So, and would that lead to volatility in the markets? Abso-effing-lutely. So anyway, my point here is this, and I think that over the course of this week, we've seen a sharp decline in some of the high flyers in the stock market. And part of that was that they're just expensive. They've run too far. The Magnificent Seven are expensive by any measure. But part of it too, I think, is because of what I'm talking about here, that the VIX over the last week has gone from 13 to 16 from Monday. Okay, so after the assassination attempt, the VIX had gone from 12.5 to 13. So no big change because it failed. From Monday until today, it's gone up 3 points. Okay, like 20% or something like that. That if you are an institutional investor, and especially if you are doing any sort of risk parity thing, you're targeting a particular level of risk, a level of volatility, and going into the next several months, the rational thing to do is to take down your equity allocation. And so I think that it may be that what we've started to see, and perhaps we will continue to see this, is that people might just back off equities a couple of percent in their allocation. If everybody in the country, all the big institutional investors back off a couple percent, that's a lot of selling of equities. And so I think that there's a reasonable chance that we get some sort of equity correction. Again, I would not make a major allocation shift if I'm an investor to get out of that. As it turns out, I'm, because I think equities are high, I'm already fairly under allocated. But there are equity products, and I'll mention Simplify. They're a sponsor of this podcast, but there are others as well that are ETFs that will allow you to be in equities and also essentially have an options overlay where if the market breaks hard, you don't do as poorly. Over time, those products, and for Simplify, SPD is the name of their product, is the ticker for their product. BlackRock also has some buffer ETFs such as IVVB and IVVM that do a little bit better if there's a modest fall. But all of these products will underperform over time because they're long options, and options have time decay. And in particular, SPD is a great example. The last time we had a decent sell-off in 2022, SPD didn't outperform the market. Why? Because we came into that sell-off with volatility already at a high level. And so when you want to own these products is when you think, A, equities are, if you think equities are expensive-ish and you think vol is cheap-ish, then that's when these products make a lot of sense. If you think that equities are already super cheap, then you don't need downside protection, right? Because they're already cheap and you just want to be long them. And if volatility is really high, then it means you have to have a really, 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 really big bad sell-off to compensate you for the time decay. So, but right now we're talking about a situation where, although the VIX is up to 16 today, when the VIX is in the 12 or 13 range, that's saying there's not going to be any volatility going forward. I think there's a good reason that there should be a volatility. Therefore, I like a product where I'm going to be long volatility. So if I, to the extent that I am going to have equity allocations, I would consider products like that. I think that over the next couple of months, we are also reaching a point here where the Fed is pivoting. There's very likely to be a rate cut, if not at the end of July, in September. And while there are plenty of people out there who are saying that interest rates will go up because we have a debt and deficit problem, which is absolutely true, that's not a problem over the next 4 months. If the Fed is easing, rates are not going to go up appreciably. I say they won't, but it's very unlikely that rates will go up appreciably if the Fed is cutting short rates. I think maybe owning long-dated bonds isn't necessarily the great idea, but I think short or medium-term bonds, and notice I didn't even say inflation-linked bonds, but inflation-linked bonds as well. I think that's the place to hide. And I think that, so you want to be long volatility in volatility products like options when they're inexpensively priced as they are now, and you want to be in fixed income. Again, no major shifts, but just tilting a little bit that way, I think makes a lot of sense over the next 3 to 4 months. I think there's going to be a lot of volatility. The volatility isn't priced into the markets. I think that makes a lot of sense. So this has been a wide-ranging and very unscripted podcast. I try to keep these things under 30 minutes most of the time, and I've failed abysmally today, and I'm sorry about that. But happy summer to you. That's all for today's podcast. Please like and subscribe and refer others. Contact me at inflationguy@enduringinvestments.com if you've got a question, or if you do need someone to give you a little more help on the investing side, then contact me there or go to enduringinvestments.com. You can subscribe for free to the blog that I mentioned at inflationguy.blog, and there's, of course, links in the show notes to other podcasts on these various topics. But most of all, and what I always leave you with is defend your money. And if inflation is coming for you, remember, you know a guy.